Everyone knows Apple is successful. The iPhone changed everything. Apple became the most valuable company in the world. Tim Cook took over from Steve Jobs and somehow made Apple even bigger. But knowing Apple succeeded and understanding what that actually meant for investors are two different things. If you had invested $1,000 in Apple stock exactly 10 years ago, in October 2015, what would you have today? How much money would you have made? Would it have been worth it? And what lessons can we learn from Apple's performance that apply to investing today? I'm going to break down the actual numbers, show you what your investment would be worth, explain why Apple performed the way it did, and extract the lessons that matter for anyone investing in stocks today. By the end, you'll understand not just what happened with Apple, but what it teaches us about successful long-term investing. Let's start with the numbers. The raw numbers, your $1,000 investment. In October 2015, Apple stock, ticker AAPL, was trading at approximately $115 to $120 per share. Let's use $117.50 as our starting point. With $1,000, you would have purchased approximately 8.5 shares of Apple after accounting for fractional shares that some brokers allow, or we'll say 8 shares to be conservative. Fast forward to October 2025, Apple stock is trading at approximately $220 to $230 per share. Let's use $225 for our calculation. Your 8.5 shares are now worth 8.5 times $225 equals $1,912.50. Your return is $912.50 profit on a $1,000 investment, or 91.25% return over 10 years. But wait, this calculation is incomplete. We haven't accounted for three critical factors. Factor 1, stock splits. Apple has had one stock split during this period, a 4-for-1 split in August 2020. This means your 8.5 shares became 34 shares after the split. The split didn't change your ownership percentage or value, but it gave you more shares at a proportionally lower price. After the split, you had 34 shares. At today's price of $225 per share, 34 times $225 equals $7,650. Your return is $6,650 profit on a $1,000 investment, or 665% return over 10 years. This is massively different from our initial calculation. Stock splits matter. Factor 2, dividends. Apple pays quarterly dividends. Over the past 10 years, you would have received dividend payments totaling approximately $450 to $500, assuming dividends were reinvested. If you reinvested those dividends into more Apple shares, which is what smart investors do, you'd have purchased additional shares over the years, increasing your total return. With dividend reinvestment, your total value would be approximately $8,200 to $8,500. Your return is $7,200 to $7,500 profit, or 720 to 750% return over 10 years. Factor 3, currency considerations for Australian investors. If you're an Australian investor, you bought Apple shares in US dollars. Currency fluctuations affect your actual return in Australian dollars. In October 2015, AUD/USD was approximately 0.72, meaning 1 Australian dollar is 0.72 US dollar. Your 1,000 Australian dollars converted to approximately 720 USD. In October 2025, AUD/USD is approximately 0.66. Your 8,400 USD position converts to approximately 12,727 Australian dollars. Your return in Australian dollars is $11,727 profit on $1,000 investment, or 1,173% return over 10 years. The weakening Australian dollar significantly boosted your returns as an Australian investor in U.S. stocks. The real answer, what you'd actually have. Taking everything into account: stock splits, dividend reinvestment, and currency effects for Australian investors. $1,000 invested in Apple in October 2015 would be worth approximately 12,700 Australian dollars in October 2025. That's a 1,170% return, or an average annual return of about 28.2% compounded. For context, the ASX 200 returned approximately 70 to 80% total over the same period, 7% annually. The S&P 500 returned approximately 180 to 200% over the same period, 11.5% annually. Apple returned 1,170%, 28.2% annually. Apple didn't just beat the market, it destroyed the market. An investment in Apple returned 15 times more than the Australian stock market over this period. What drove Apple's performance? Understanding why Apple performed so well teaches us what to look for in other investments. Driver 1. Product ecosystem expansion. In 2015, Apple was primarily an iPhone company. The iPhone generated about 65 to 70% of revenue. Over the next 10 years, Apple systematically expanded its ecosystem. Apple Watch, launched in 2015, now massive health and fitness category. AirPods, launched in 2016, dominating wireless earbuds. Services, Apple Music, iCloud, App Store, and Apple TV Plus grew from 10% of revenue to over 25%. Wearables became a $40+ billion annual business. This diversification reduced dependence on iPhone and created recurring revenue streams through services. Driver 2, services revenue transformation. Services revenue grew from $20 billion in 2015 to over $85 billion in 2024. This is crucial because services have much higher profit margins than hardware. Services margins, 70+%. Hardware margins, 35 to 40%. This shift toward services dramatically improved Apple's profitability and stock price. Driver 3, share buybacks. Apple has spent over $500 billion buying back its own shares over the past decade. This reduced the number of shares outstanding, making each remaining share more valuable. When a company buys back shares, remaining shareholders own a larger percentage of the company without buying additional shares. This artificially but legitimately boosts stock price. Apple's aggressive buybacks were a major driver of stock performance. Driver 4. China market penetration. Apple successfully penetrated the Chinese market, making China its second largest market after the U.S. Revenue from Greater China grew from $60 billion to $70+ billion despite geopolitical challenges. This geographic expansion opened enormous growth runway. Driver 5. Margin expansion. Apple's gross margin, profit after cost of goods sold, expanded from about 38% in 2015 to 44–46% in 2024–2025. Higher margins mean more profit per dollar of revenue, which flows directly to the stock price. Driver 6. Multiple expansion. Apple's price-to-earnings ratio, PE, expanded from about 12 to 13 in 2015 to 25 to 30 in 2024–2025. This means investors are willing to pay more for each dollar of Apple's earnings than they were 10 years ago. This multiple expansion happens when investor sentiment improves and the company proves consistent performance. Multiple expansion alone added 100% to Apple's stock price beyond earnings growth. What about different entry points? The $1,000 in October 2015 is arbitrary. What if you invested at different times? If you invested $1,000 in January 2020, pre-COVID, your $1,000 would be worth approximately $4,800 AUD today. 380% return over 5 years, or 37% annually. If you invested $1,000 in March 2020, COVID crash, Apple briefly dropped to $55 to $60 per share, split adjusted. Your $1,000 would be worth approximately $5,800 AUD today. 480% return over 4.5 years, or 52% annually. If you invested $1,000 in January 2023, your $1,000 would be worth approximately $1,900 AUD today, 90% return over 2 years, or 38% annually. The lesson? Almost any entry point in the past 10 years would have been profitable, but buying during the COVID crash would have generated exceptional returns. If you invested $1,000 at the peak in December 2021, Apple hit an all-time high around $180 split adjusted. Your $1,000 would be worth approximately $1,250 AUD today, 25% return over 3 years, or 7.7% annually. The lesson? Even buying at the absolute peak would have been okay, but returns would have been mediocre for several years. The dollar-cost averaging approach. What if instead of investing $1,000 all at once in October 2015, you invested $100 per month for 10 months starting in October 2015? This dollar-cost averaging approach means you buy more shares when prices are low and fewer when prices are high. Calculation. Month 1, October 2015, $100 at $117 equals 0.85 shares. Month 2, November 2015, $100 at $118 equals 0.85 shares. Month 3, December 2015, $100 at $107 equals 0.93 shares, etc. After the stock split and 10 years of appreciation, your 10 monthly investments of $100 would be worth approximately $12,400 to $12,800 AUD. Slightly lower than the lump sum investment because dollar-cost averaging typically underperforms lump sum investing in rising markets, which Apple was. But dollar-cost averaging provides psychological comfort and reduces the risk of investing everything at a peak. What if you held even longer? $1,000 invested in Apple 20 years ago, October 2005, would be worth approximately $145,000 AUD today. $1,000 invested in Apple 30 years ago, October 1995, would be worth approximately $880,000 AUD today. $1,000 invested in Apple at its 1980 IPO would be worth approximately $2.5 million AUD today. The lesson? Time in the market beats timing the market. The longer you hold quality companies, the more compounding works in your favor. But these numbers come with survivorship bias. Apple could have failed. Many technology companies from 1995 or 2005 went bankrupt. We're only looking at Apple because it succeeded. Lessons for investors today. What can we learn from Apple's performance that applies to investing today? Lesson 1. Quality compounds. Apple wasn't a speculative gamble. It was already a successful, profitable company in 2015 with $200 billion in annual revenue. Quality companies with strong fundamentals, competitive advantages, and consistent profitability tend to compound wealth over long periods. Look for companies with sustainable competitive advantages, consistent profitability and positive cash flow, manageable debt levels, competent management, and growing addressable markets. Lesson 2. Long-term holding wins. Investors who bought Apple in 2015 and held through 2016 iPhone sales concerns, 2018-2019 China trade war fears, 2020 COVID crash, 2021 to 2022 supply chain issues, 2023 rate hike concerns earned 1,170% returns. Investors who panic sold during any of these concerns missed the gains. Long-term holding requires conviction in your investment thesis and tolerance for volatility. Lesson 3. Diversification still matters. Apple's performance was exceptional, but its survivorship bias to conclude just buy Apple. Many investors in 2015 also bought GoPro, down 80% plus from 2015 highs. Fitbit acquired mediocre returns. BlackBerry effectively failed. other tech companies that didn't pan out. Having all your money in Apple would have been fantastic in hindsight, but it would have been reckless prospectively. Diversification protects against picking wrong. Even if your Apple position was just 10 to 20% of your portfolio, it would have significantly boosted overall returns, while other positions protected you if Apple had failed. Lesson 4. Don't try to time the market. Investors waiting for the perfect entry point in Apple over the past 10 years missed out on 1,170% returns. Yes, buying at the COVID crash would have been better, but how many investors actually had the courage to buy during a global pandemic when unemployment was spiking? Most investors who wait for perfect timing end up never investing. Getting in the market, even at imperfect times, beats sitting in cash waiting for perfection. Lesson 5. Currency risk/opportunity matters. For Australian investors, the weakening AUD against USD added 50 to 70% to their returns beyond Apple's stock performance. When investing internationally, consider currency as a factor. It can significantly help or hurt returns. Lesson 6. Dividends and reinvestment matter. Apple's dividends added $450 to $500 to returns over 10 years. Reinvesting those dividends added another $500 to $800. Always reinvest dividends unless you specifically need the income. Dividend reinvestment accelerates compounding dramatically. Should you buy Apple now? This is the question everyone asks after seeing these returns. Arguments for buying Apple today: still dominant ecosystem with 1.5 billion active devices. Services revenue growing and improving margins. Wearables and health tech growth runway. Strong balance sheet and cash flow. Consistent share buybacks. Apple Vision Pro, spatial computing, potential. AI integration opportunities. Arguments against buying Apple today: valuation is high, PE of 28 to 30 versus historical 15 to 20. iPhone sales growth is slowing, market saturation. China geopolitical risks. Regulatory scrutiny on App Store and services. Innovation concerns no groundbreaking products since Apple Watch or AirPods. Size limits growth. Hard to grow fast at $3.5 trillion market cap. My take: Apple at $225 per share in 2025 is a different investment than Apple at $117 split adjusted in 2015. The valuation is higher. The growth is slower. The upside is more limited. Could Apple double again over the next 10 years? Possibly. That would require reaching $7 trillion market cap, which would be unprecedented. Could Apple return 1,170% like it did the past 10 years? Extremely unlikely. The math doesn't support it unless Apple invents entirely new categories that generate hundreds of billions in revenue. More realistic expectation: Apple might return 80 to 150% over the next 10 years, 6 to 10% annually, which would be solid but not extraordinary. Apple is probably still a good long-term hold, but expectations should be tempered. The explosive growth is behind it. Steady, mature company returns are ahead. The bottom line: $1,000 invested in Apple 10 years ago would be worth approximately 12,700 Australian dollars today, a 1,170% return. This spectacular performance came from product ecosystem expansion, services revenue growth, massive share buybacks, geographic expansion, margin improvement, multiple expansion, currency benefits for Australian investors. But Apple's past performance doesn't guarantee future results. At current valuations, Apple is more likely to deliver steady 6 to 10% annual returns than explosive 28% annual returns. The real lessons aren't buy Apple. The lessons are invest in quality companies with competitive advantages, hold long-term through volatility, diversify to protect against being wrong, don't try to time the market perfectly, reinvest dividends, consider currency effects for international investments. If you apply these lessons to a diversified portfolio of quality companies, you don't need to pick the next Apple. You just need to avoid major mistakes and let compounding do its work over decades. Apple's 1,170% return over 10 years is impressive, but the real wealth was built by investors who didn't panic sell during the down periods, who held with conviction, and who let time and compounding work their magic. That's replicatable. You don't need to be a genius or get lucky. You just need patience, discipline, and a focus on quality. That's the real lesson from Apple's last 10 years.